Okay, so in this particular episode, what we'll be discussing about is words. Okay, so it's a question from SPR's exam kit, and then what does the question say? It says that Verge, in its annual financial statement for the year ended 31st March 20x3, Verge, a public limited company, had identified the following operating segments: Segment 1, Segment 2, Segment 3, local train operations, intercity train operations, and railway constructions, right? The company disclosed two reportable segments. Segment 1 and Segment 2 were aggregated into single reportable operating segment. Operating segment 1 and 2 have been aggregated on the basis of their similar business characteristics and the nature of their products and services. In the local market, it is local transport authority which awards the contract and pays Verge for its service. In the local train market, contracts are awarded following a competitive tender process, and the ticket price paid by passenger are set and paid to transport authority. Okay, so it is set. Not Verge is not setting it, but the transport authority sets the price in local train, right? In intercity train market, ticket prices are set by Verge and the passengers pay Verge for the services provided. Right, so this is number 2. So what are our requirement? Advise person how the above accounting issues should be dealt with in its financial statement for the year ending 31st March 20x2 where applicable. Okay, in this we are only talking about x3, right? And 31st March 20x3. So operating segments, let's talk about this. We talked about it many times. IFRS 8 operating segments states that the reportable segments are those operating segments or aggregation of operating segments for which segment information must be separately reported. Aggregation of one or more operating segments into a single reportable segments is permitted but not required where certain conditions are met, such as the principal condition being that the operating segments should have similar economic characteristics, right? When they have similar economic characteristics, then only they can be uh, aggregated, which we need to talk about over here, right? So they should be, the primary condition of that is they should have a similar economic characteristics, right? The segments must be similar in terms of the following respects. What are they? The nature of the products and services, nature of the production process or processes, type or class of customer. This will be different in this for sure because it's the intercity train and local train, right? So the type of customer will definitely be different. The methods used to distribute their product. Remember when we did a thing when there was a one particular subsidiary or something that had been acquired, and then after that what had happened was it a reportable segment or not? That's what the question had asked, and then it had given us a similar another entity and which had a omni-channel distribution. One was only selling online and then the other was selling online and offline as well, right? So their method of distribution was different, so they were classified as operating segment, right? So they were not aggregated, right? We had done that. Provide their services. Nature of the regulatory environment. This is also kind of a bit different because the regulator sets the price, right? So the price control is there. Segment 1 and 2 have different customers. The decision to award or withdraw local train contracts rests with the transport authority and not with the end customer. Right? Whereas in case of the other thing, they don't have to do any bidding or anything. So they can ride in this particular company's train or not, or they can go in other company's train, right? Not the not with the end customer, which is the passenger. In contrast, the decision to withdraw from a route in local, in intercity train market would normally rest with Verge, right? So the decision making authority is with Verge itself. But would be largely influenced by the passenger's action that would lead to out becoming economically unviable. It depends on the action of the passenger, right? In view of the fact that the segments have different customers, the two segments do not meet the aggregation criteria. Another thing that has happened is that in the local train market, contracts are awarded following a competitive bidding process, and consequently there is no exposure passenger revenue risk, right? Because it will be paid by the company. Pays for its service, right? The ticket prices paid by passengers are set by a transport authority and not Verge. By contrast, in the intercity train market, train ticket prices are set by Verge and its revenues are therefore the fares paid by the passenger traveling on the train. In this set of circumstance, the company is exposed to passenger revenue risks. This risk reflects, or this risk would affect the two segments differently, but generally through the action of the operating segments. Customer, right? Therefore, the economic characteristics of the two segments are different, and so they should be reported as separate segments. Okay. 7 marks, I think that should do the job. So next thing is, so Verge entered into a contract with a government body on 1st April 20x1 to undertake maintenance services on a new railway line. The total revenue from the contract is 5 million over a 3-year period. Okay, so the contract states that 1 million will be paid at the commencement of the contract, but although invoices will be subsequently sent at the end of each year, the government authority will only settle the subsequent amounts owing when the contract is complete. Okay. The invoices sent by Verge to date, including 1 million above, were as follows. So on this date, they sent that much, 2.8, and then 1.2 million, right? And then the balance will be invoiced on 31st March 20x4. Verge has only accounted for the initial payment in the financial statement to 31st March 20x2, as no subsequent amounts are to be paid until 31st March 20x4. The amounts of the invoices reflect the work undertaken in the period. Verge wishes to know how to account for the revenue in the contract in the financial statement to date. Market interest rates are currently at 6%, right? Okay. So IFRS 15, right? Let's talk about that first of all. So what are we doing over here? Main thing that we are providing is maintenance service, right? Okay. Maintenance services are simultaneously received and consumed so as per IFRS 15, revenue from contracts with customers that the revenue should be recognized over time based on the progress towards the satisfaction of the performance obligation, right? can use input or output method, but there is also a clause. Thus, Verge must recognize revenue as work is performed on contract life. So 5 million. Length between transfer of the promised services and the payment date suggests that there is a significant financing component. Consideration should be discounted to present value using market rates. The payment is only occurring after 2 years, right? In the year end, the first year end is 31st March 2022, right? In the year end, 31st, the year ended 31st March 20x2, the Verge should have recorded revenue of dollar. How much is the work done? Dollar 1 million plus dollar 1 million. No, not 1 million only. Okay, let's use the calculator. It'll be easier that way. Into 1 divided by 1.06 to the power 2, right? Let's use the calculator. 1.8 into what we could do is divide by 1.06 out to 1.6, right? Plus 1, 2.6. So this will give us 2.6 million. Since Verge has received $1 million cash, a receivable of $1.6 million should have been recognized in the year ended 31st March 0x3. Revenue should be recorded at so what's the expense during this period? 1.2 million. So why I did only 1.8 was that it included that 1 million amount. Okay, that's why, because 1 million has already been paid, right? So the next amount is 1.2, right? 1.2 million. So this is already done. So 1.13, right? Okay, so dollar 1.2 million into 1 divided by 1.06. This will be 1.20, right? 20 million. In addition, discount on the receivable recognized in the year ended would be unwounded. Consequently, there will be interest income of so 1.6 million into 6%. 1.6 into 6% is 1.6. 6 into 0.06, 0.096. That means 96,000. So they have not made any entry, right? that is prior period error. Prior period error are omissions from and misstatement the entity's financial statement for one or more period arising from the failure, use or misuse of reliable information that was available when financial statements for those periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Such errors include mathematical mistakes, mistakes in applying accounting policies, and fraud. The fact that Verge only included $1 million of the revenue in the financial statements for the year ended 31st March 20x2 is a prior period error. Verge should correct the prior period error retrospectively in the financial statement for the year ended 31st March 20x3. The comparatives should be restated for errors. This is what should be done as well, right? That's pretty much it, guys, for this. So next on we will be looking at the next question as well. So since it has been quite a long video, so I'll pause over here and then I'll continue it in the second part. Okay, so that will basically be good for everybody, so that we have the train of thought along with us. So if you have any confusions until now, please do comment down below. I'll definitely be looking forward for your comments and I'll be very happy to answer your queries. So until next time, bye bye.